Hello and welcome to ACCA Notes. Today our topic is IAS 2. Inventories. It is mainly about the accounting treatment for inventories. Its objective includes guidance for determining the cost of inventories, and for subsequently recognizing an expense. It also provides guidance on the cost formulas that are used to assign costs to inventories. Its scope involve assets held for sale, assets in production process, material and supplies consumed in production process. It exclude work in process arising under construction, financial instruments, biological assets and agricultural produce at the point of harvest. For cost measurement, IAS 2 have a fundamental principle which says that inventories are required to be stated at lower of cost and net realizable value. Measurement of inventories. According to IAS 2, inventory initially measured at cost. As per to IAS 2, the cost an item of inventory includes purchase costs, conversion costs, and any other costs required to get it to its current condition and location. Purchase cost. Purchase cost includes purchase price, import duties, irrecoverable taxes, transport and handling costs and net of trade discounts received. Conversion costs. Conversion cost includes all direct costs of conversion, material labors, expenses etc., a proportion of fixed and variable production overheads. The allocation of fixed production overheads must be based on the normal level of activity. Other costs includes all other costs incurred in bringing the inventories to their present location and condition. Here's a thing to note. Abnormal wastage, storage costs, administration costs, and selling costs must be excluded from the cost valuation and charged as expenses in the period in which they are incurred. Let's talk about costing method under IAS 2. The standard allows three methods of arriving at cost. Actual unit cost. First in first out. Weighted average cost. Actual unit cost must be used where items of inventory are not ordinarily interchangeable. Subsequent measurement. Inventories may be sold below cost if they are damaged, there is a decline in demand, or if the market is increasingly competitive. It may also be that items or work in progress are overstated, if there has been a rise in the costs requires inventories to be written down to lower of cost and net reliable value on a line-by-line basis. What is net reliable value? It is estimated proceeds from selling the inventory less completion and selling costs. The NRV of inventory held to satisfy a sales contract is normally evidenced by the contact. However, in other cases, NRV must be estimated. Sales of inventory after reporting provide strong evidence about its NRV as at reporting date. When measuring NRV, the standard permits similar items to be grouped together, assuring they are sold in the same market. Raw materials are not written down below their cost if the finished good they will form a part of will be sold at a profit. However, a decline in raw material prices would suggest that their NRV has fallen below purchase cost. In such cases, the replacement cost of raw materials provides evidence of their NRV. Disclosure. IAS 2 require following to be disclosed. The total carrying amount of inventory by category. The details of inventories carried at NRV, net reliable value. That's it. That was all about IAS 2 inventory. Now comments below and let us know which next standard you want to learn about. Have a nice day and do not forget to like, share and subscribe the channel.